Did you know that a single mistake in an equity release agreement could cost you your entire home? That's not fear-mongering, that's reality. The equity release industry markets itself as a golden ticket for retirees, promising easy access to the wealth locked in their homes. But beneath the glossy brochures and friendly financial advisors lies a financial trap that too many homeowners don't see until it's too late. Welcome to Factful Finance, where we cut through the noise and expose the hard-hitting truths that financial institutions don't want you to know. Today, we're dismantling some of the most dangerous myths about equity release, misconceptions that could drain your wealth, saddle your heirs with debt, and even leave you without a roof over your head. If you've ever considered unlocking the value of your home, stay with me, because what you don't know can hurt you. One of the biggest myths? Equity release is just another type of mortgage. Many homeowners assume that because they've handled mortgages before, they can easily navigate an equity release deal. But here's the stark difference. A traditional mortgage has an end date. You make payments. You eventually own your home outright. Equity release, on the other hand, is structured to compound against you. Interest builds upon interest, meaning the debt can snowball to a point where your home is worth less than what you owe. Take Richard and Susan, a retired couple in Kent. They took out an equity release plan to fund their retirement dreams. Holidays, home renovations, a little extra breathing room. The initial sum they borrowed, £50,000. Within 15 years, due to compounding interest, their debt had grown to over £150,000. When they passed, their children were left with a shock. The house was no longer theirs. The lender took it all. Another myth? You can always move house after taking out an equity release loan. The reality? Not so simple. Many equity release plans tie you down, either with high early repayment penalties or clauses that prevent you from transferring the loan to a new property. If your circumstances change, say you need to downsize, move for medical reasons, or be closer to family, you may find yourself trapped in an arrangement that makes moving financially impossible. And then there's the belief that your family will inherit whatever's left after the loan is repaid. In truth, many homeowners underestimate just how quickly compound interest erodes home equity. According to the UK's Financial Conduct Authority, the average equity release interest rate sits between 6% and 8%. That may not sound like much, but with compound interest, a £100,000 loan at 7% doubles in just 10 years. If you live for 20 or 25 years after taking out an equity release, your debt could far exceed the value of your home, leaving your loved ones with nothing. So what's the alternative? If you're looking to access wealth without risking your home, consider downsizing, exploring government-backed support schemes, or leveraging pension income more effectively. There are also hybrid financial products that allow you to borrow against your home without falling into the compound interest trap of a traditional equity release scheme. Financial decisions of this magnitude should never be made without expert advice. Speak with a qualified financial professional who understands your long-term needs and can help you assess all your options before committing to a choice you can't undo. What's your biggest concern about equity release? Drop it in the comments. I read every single one. And if this has been an eye-opener for you, there's even more you need to know. Click on the next video because the financial industry has a lot more secrets to reveal.